Good evening, members and guests, and welcome to our Get Set for Retirement webinar. It's fantastic that you could take some time out of your evening to hear about what's been happening with your super fund and how to plan for your retirement. My name's Kate Farrar. I'm the Chief Executive Officer of Brighter Super, and with me tonight we have Robb, one of our member account managers. Before we start tonight's webinar, I'd like to acknowledge the traditional owners of the lands on which we're meeting and pay my respects to their elders, past, present and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. Tonight's presentation will run for around an hour, including time for questions at the end. So if you'd like to ask questions, you can submit your question by clicking on the little blue hand at the top of your screen. If you're viewing on your mobile device, please use the Chrome app for the best experience. So I'll start tonight's presentation by providing you with a brief update on your fund, including the transition to our new brand and name, Brighter Super. I'll then hand over to Dan, who'll take you through how much you may need to retire comfortably. Dan will also present information on how to build your retirement savings, and he'll explain the different types of income that you can access when you're retired. I'd like also to advise you that the information that we're presenting is general information only. It's been prepared without taking into account your individual objectives, financial situation or needs. You must not rely on the information alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. So, what does the future look like for our members? As you know, on the 1st of July last year, the merger of Energy Super and LGI Super formed the foundation on which the Brighter Super Group was built. We then welcomed Suncorp Super to the group in April 2022. On July 1st this year, our members from LGI Super were the first to transition to the Brighter Super name. Our Energy Super Foundation members will start to see the Brighter Super brand on your accounts in September. With our foundation funds coming together, we're committed to working towards a brighter future and even more benefits to our members. But despite our growth and name changes over time, your experience as a member will remain the same, and we remain committed to our heritage in the energy and local government industries. You'll continue to receive the same great service you've always experienced, and you'll still talk to the same friendly staff you already know. Rest assured, we'll also continue to focus on delivering solid long-term returns to help give you the best possible retirement. We hope that you'll notice that our size gives us an edge compared to mega funds and allows us to respond to the different needs of our members. In this rapidly changing superannuation sector, we always want to remain agile and responsive to ensure the best outcomes for you all. Bringing three funds together without sacrificing personal service does just that. So why the name Brighter Super? Brighter Super came about because it represents different elements of each of our foundation funds. It reflects the strengths and values of the three funds and their commitment to delivering the best possible retirement outcomes for our members. For Energy Super, Brighter represents the bright spark in the energy industry. For LGI Super, Brighter is the spirit of community that unites the proud Queenslanders who established our fund 57 years ago. For Suncorp Super, Brighter is one of the products that was offered in recognition of the Queensland roots of the fund. As I mentioned, our foundation funds will rebrand to Brighter Super in all communications in stages, with LGI Super early this month, Energy Super in September, and Suncorp Super in the future. Our research shows that members of our foundation funds value the personal approach, and that is what will continue to set us apart. Together, we now have 260,000 members and almost 30 billion in funds under management. So we're big enough to matter, but still small enough to care. One example of what this means for us as a business is that we're ensuring that every member of our team understands how their job delivers value to our members. This ensures that everywhere in our business, our team members, even those you don't see day to day, understand why their particular job is important in helping real people like you. This means that you're dealing with a fund where the person processing your investment switch request, for example, understands that this task has a direct connection to an important life moment and decision for you at that time. It's this philosophy that we're working to flow through our combined business and make us truly different from other funds. As a $30 billion fund that's been built by our foundation funds, all members can expect to see several benefits from this integration in the near future. We'll have increased access to high-performing mid-market investments with a focus on assets that build communities and support our members where they live and work. We've already reduced total fees and costs for Brighter Super, formerly known as LGI Super, and Energy Super MySuper members. For Brighter Super members, total fees and costs have reduced by up to 28%. An example of this benefit is that a member with a super balance of $150,000 in MySuper is now benefiting from an annual reduction of total fees and costs of approximately $307. For Energy Super members, fees and costs have reduced by up to 29%. An example of this benefit is that an Energy Super member with a super balance of $150,000 in MySuper is now benefiting from an annual reduction of total fees and costs of approximately $337. We've passed on these savings by reducing our administration, marketing and investment costs. Moving all members to one brand, Brighter Super, will allow the group to reduce marketing and administration costs even further, which will be another driver in reducing our fees and costs for you. In the future, we look forward to extending these fee reductions to Suncorp Super members when they officially join the Brighter Super group. At the same time as lowering our costs, we've delivered better products and services for our Brighter Super members. We've introduced 2 new investment options. We've launched a new mobile app giving members an easy, convenient and secure way to manage their super. And we've added new features and enhancements to Member Online. These features and new investment options will be available in September to Energy Super members as part of moving on to the Brighter Super brand. We're proud to be a medium-sized boutique fund, which means we can remain close to our members and provide personalised service. We continue to invest in delivering our member services across more than 200 locations and expanded our regional presence with teams located in central and northern Queensland. So what's next for Brighter Super? As we head into the rest of the year with high inflation and continued uncertainty, Brighter Super will continue to find unique ways to benefit and enhance the lives and super of our members. As we've discussed, our new branding, which has already changed for LGR Super members and will change for Energy Super members in September, is designed to bring our offering together as one. For Energy Super members, there will also be a transition of the administration platform to one system. This means there will be changes to your member portal and mobile app. This unification of our systems is another important part of delivering the cost savings and improving our services for you. There will be communications to all Energy Super members in the coming months about these changes. We'll also continue hosting events like these and keep our personal connections with members. I encourage all of you to attend these events and reach out so you can feel part of this journey as much as we do. I'll now hand over to Dan, who will take you through how much you may need to retire comfortably. Thanks.
And thank you very much, Kate. And thanks to all of you for attending this evening's webinar. Thank you. It's great to have the opportunity to talk to you all tonight. As a member account manager with Brighter Super, my main role is to help our members better understand their super. During my 17 years working in the superannuation industry, I've been asked probably thousands of questions about super, and I've never heard a silly one yet. Not surprisingly, the main question revolves around what exactly a comfortable retirement looks like. Tonight, we're going to provide you with the information so you can answer this question for yourselves. We're going to do this by focusing on 3 key areas. What is a comfortable retirement and how much might you need to get you there? What are the options for getting your super working harder for you? And how can I access an income in retirement? As Kate mentioned, the information we're covering tonight is general in nature only, and it does take a higher level look at retirement planning needs. As always, do take the opportunity to seek further guidance from a financial advisor who can consider your personal circumstances when providing those recommendations for you. So let's get things underway and look at how you can start to find you're comfortable. George Harrison once sang, "If you don't know where you're going, any road will take you there." When it comes to achieving a comfortable retirement, start with a plan. It's never too early to start thinking about your future lifestyle and what it may look like. For a lot of members that I talk to, a comfortable retirement involves travel. It might be the big overseas trip. I was talking to a member earlier today who's planning a wedding in Greece later in the year. It could be exploring our own beautiful backyard. For others, a comfortable retirement is all about family and friends, spending time with loved ones, enjoying a range of different social activities. Maybe take a moment now to think about what your comfortable lifestyle looks like to you. For a lot of people, visualising their retirement lifestyle is quite easy. But if you're not quite sure, the good news here is that someone's already established what a comfortable lifestyle might look like. The Association of Super Funds of Australia, or ASFA, regularly survey retirees who have paid off the mortgage to find out what they're spending money on in retirement. The comfortable retirement standard allows retirees to maintain a good standard of living in their post-work years. It accounts for the daily essentials, which can include groceries, transport and home repairs, as well as private health insurance, a range of exercise and leisure activities, and regular restaurant meals. Also, it enables retirees to take that annual domestic trip and the international trip maybe once every 7 years. Very important to remember, everybody's lifestyle is different, so use this as a guide. Once you've got a bit of an idea what you might like to do in retirement, you might then want to think about how much it's going to cost. Now, depending on your own personal situation, the dollar figures we're going to see may allow you to achieve that comfortable lifestyle. These figures are updated on a quarterly basis. So maybe take a minute now to think about how much you're currently spending on your own lifestyle. The numbers here on the screen do assume that the income is coming from a superannuation pension at the age of 65. We're estimating investment returns of 2.5% above inflation. The figures are also tax-free. The reason for that is that super withdrawals are tax-free once you reach the age of 60. So let's now have a look how that translates to a lump sum. For some members that we talk to, the age pension is going to be part of their retirement income. For others, prefer to be fully self-funded. It's up to you. If you're closer to retirement, the chances are the age pension will factor in depending on your superannuation balance. However, if you've got a long way to go before retirement, you might want to focus on those self-funded figures. This can have the effect of protecting you from future changes to the age pension. And a little bit later on, we'll take a closer look around the rules on the age pension. Either way, the key to achieving your comfortable lies in planning early and getting the right advice. Now that we've got an idea of what a comfortable retirement may look like, let's now have a look at how investment decisions can help you achieve that. Now, not surprisingly, over the last 12 months particularly, a lot of members that I talk to have been pretty concerned about what's going on in the markets and the market volatility. It's really important to bear in mind that markets will naturally go through ups and downs. And it's the decisions that you make that can help you achieve your comfortable. And remember, the key is superannuation is a long-term investment. So let's have a bit of a closer look at some of the considerations and some of the options that you can make. Now, it's very important to note that the investment options shown on this slide are specific to the Brighter Super and Energy Super members coming along this evening. The principles that I'll be covering do apply to everybody. One thing you need to consider is the balance between risk and return, and also the time frame that's involved. A lower risk option, such as cash, will have limited volatility in the short term. It will also be more conservative in the longer time frame. Higher risk options can regularly change in value. However, they will generally provide a high return over the longer time frame. A good general rule with investing is diversification. This means spreading your investment options across a range of different asset classes, or if you prefer, not putting all of your eggs in the one basket. For Brighter Super and Energy Super members, we offer a suite of diversified investment options that are structured to help you achieve positive returns over various timeframes with appropriate levels of risk or volatility. So let's have a look at some of these concepts in a little bit more detail. So what we're looking at here are three of the different asset classes and how they respond, the impact on $10,000 over various periods of time. We're starting off with a fairly short time frame, 12 months. The pink line represents the cash option. Again, cash is the lowest risk investment option, very limited volatility in the short term, and as you can see, over the 12 months, it's growing very slowly and steadily. The green line represents the My Super option, which is the default investment option for Brighter Super and Energy Super members who have not made an active investment decision. It has a higher risk profile So over that 12-month period, you can probably see there is a lot more volatility. The aggressive option is another diversified investment option which does have a higher exposure to shares, which means, again, more volatility in the short term, but as we'll see in a moment, can also translate to generally a higher return in the long run. Now, this is where it's really important. We've certainly seen this over the last financial year. Again, a lot of volatility in the short term. What if we extend the time frame? The only thing we're changing here is that time frame. We're looking at the same three asset classes and the same three principles. However, as you can see, over the longer time frame, cash is still conservative, still very limited volatility, but those ups and downs in the more diversified, more aggressive strategies are actually translating to a higher return in the long run. This is why it's so important to consider your own attitude to risk and also looking at your own time frame. So considering that time frame is essential. I have a member that I regularly deal with. He's based up in Mackay. I spoke to him earlier on this year. He was looking to retire in July. He's 59 years old. He's very keen to retire at 60, and he's got a certain dollar figure in mind, but he's actually pushed his retirement date back based on the recent market volatility. I'll tell you the same thing that I say to him as well. Again, it's general financial advice. Your time frame doesn't necessarily end when you finish work. For example, if you're 58, 59 years old, you're reasonably healthy, and you're thinking about finishing work at 60, which many members do, you're quite possibly looking at maybe another 24 to 27 years in retirement. This adds to your time frame. And just because you finished work doesn't mean that your relationship with superannuation ends. As always, getting further advice is a great idea. You can talk to our financial advisors who can take you through a risk profile, give you recommendations at no additional cost. So now that you know a little bit more about what to consider around investments, let's have a look at exactly how the money gets into your superannuation. The main purpose of super is to give you an income in retirement. So it's often the changes that you make early that can make a really big difference. The other important thing to keep in mind, super is determined to be a long-term investment. But let's take it back a step by having a look at where your money goes to. And something that I've learned in my time in the industry is that it's not always about how much you earn, but it's how you manage it. So let's have a look at where the money goes before it hits your pocket. So we're going to focus on your salary. Before the gross income goes to you, it's assessed for tax. Marginal tax is deducted, and this is sent off to Canberra. One of the two things in life that we can't avoid, and we'll touch on the other one a little bit later on in relation to your super. The next thing to think about are the fixed or essential expenses. These can include having a roof over your head, putting food on the table, keeping the lights on, and potentially raising the kids. Now, if the last couple of years has taught us anything at all, it's that you need to look after yourself and have a bit of fun. It's really important, of course, to have the money to do the things that you enjoy doing. Now, a really good habit that you can get into, and my dad taught me this one as well, is putting aside a bit of money as soon as you get paid, so you've got money building up in that fund jar. So when you want to do those sorts of things you enjoy, the money's already there. You don't have to give up on it or scramble around to find it where it is. It's a concept called paying yourself first. You might want to set up another account with a higher interest rate as your fund account. And finally, there's the future. This might be savings for a home deposit or for retirement. And this is very much where superannuation comes into the equation. Many of our members are required to put money into super. And the good news here is you can choose the way which works best for you. An after-tax contribution simply means that marginal tax has been deducted prior to money going into your super. If you're earning between $45,000 and $120,000, the marginal tax rate is generally 34.5%. There's no tax on entry to your super contributions when they go into your fund. If your employer allows you to salary sacrifice, or if you're claiming a tax deduction on those after-tax contributions, it's taxed at a rate of 15% on entry to the fund. So you're probably asking yourself, which is the best way to go? It really depends on your personal circumstances. And again, you should really seek further advice as to what works best for you. As a general rule of thumb, if you're earning between $45,000 and $120,000, you may be saving some tax if you look at putting your super contributions in before tax. So let's have a look at a general example of how this can work. Let's make the assumption that this particular member is looking at putting $5,000 into their super across the financial year, and they're earning between $45,000 and $120,000. If they make an after-tax contribution, the tax that they'd be paying would be $1,725. If their employer allows them to salary sacrifice, or if they're claiming a tax deduction, they would be looking at saving around $975 per year based on the difference in tax rates. That's extra money in your pocket. It's up to you to do what you want to do with this money. You might have some immediate financial commitments, or you're thinking towards the future. For a lot of members that we talk to, this can be a great way to boost up their retirement savings. The logic is that the money that they didn't have before, so they're not missing it, so they're thinking about the future. So let's have a look at an example of how this could potentially work for you. Introducing Wyatt. Wyatt is 55 years old. He's been working for about 35 years, and he's built up a superannuation balance of $200,000. Wyatt's financially in a position where he can potentially put some extra money into superannuation. We've also made some assumptions in relation to his investment returns. He's looking to retire in 5 years' time. His mortgage is under control. The children are looking after themselves. They've grown up, of course. And he's looking to boost up his super by an additional $5,000 contribution each financial year with the plan to retire at the age of 60. So first of all, if he was to put that $5,000 as an after-tax contribution, so after marginal tax has been deducted, his projected super balance would be around $278,000 at the age of 60. After seeking personal advice, he decides to make these extra contributions via salary sacrifice. Now, as we can see, by making a relatively small change, this will help Wyatt have an extra around about $22,000 in his super at the age of 60. And over $5,000 of that is money that otherwise would have gone to Canberra. Now, it's something to think about. Of course, as with anything in life, there are rules that apply. Under federal government legislation, there are limits as to how much you can contribute to super each and every financial year to receive those tax concessions. The concessional contribution limit for the current financial year is $27,500. Concessional contributions include employer contributions, any salary sacrifice contributions, which can be a requirement of your employment, or voluntary contributions, and tax-deductible contributions. If you exceed the cap, excess contributions are taxed at your marginal tax rate. Now, depending on your own superannuation arrangements and how much you've got in your super, you may have some extra room under this cap. A recent legislative change allows you to potentially carry forward any unused concessional cap from previous financial years. It was actually introduced in the federal budget back in 2018 and came into effect in the 2019-2020 financial year. And it stops with the 2024-2025 financial year. To be eligible for this carry forward, as it's referred to, you must have a super balance under $500,000 at the start of the financial year that you're making those contributions. Here's how it works. In the 2019-2020 financial year, the concessional contribution cap was $25,000. Let's assume that this member puts in $10,000 as a concessional contribution. That means that the unused cap of $15,000 transfers to the following financial year. If in 2020-2021 financial year, they again contribute $10,000, the unused cap is now $30,000, which transfers across to the next financial year's limit, and so forth. So as we can see, by the third year, the effective cap for this particular member is actually now $57,500. This can be a great way to get you towards that comfortable lifestyle. For example, if it's someone who's taken some time out of the workforce, maybe to look after their family, a great opportunity to boost up their super. And the good news here, there are also some other ways in which you might be able to get extra money into your super without necessarily putting your hand in your pocket. An important thing to bear in mind that there are also limits as to after-tax contributions. And these could come into play if you're looking at making a large lump sum contribution to super. For example, you might be selling an investment property or receiving some money as an inheritance. Under current rules, you can contribute up to $110,000 per financial year. Up to the age of 74, you can bring forward up to $330,000 over a rolling 3-year period. From the 1st of July this year, there's no longer a need to meet the work test if you are making an after-tax contribution. If you're aged between the ages of 67 to 74, you will be required to meet that work test if you're looking at claiming a personal tax deduction on your after-tax contributions. To meet the work test, you must be gainfully employed for at least 40 hours during a consecutive 30-day period in the financial year which the contributions are made. If you're 60 and over, selling your primary residence, you can also put the proceeds into your super on top of that bring forward. Now, it's very important to note that you must have lived in that particular home for at least 10 years. This can only apply after the age of 60. And it has reduced from 65 for the previous financial year. There's no need to meet the work test regardless of your age and also regardless of the balance of your super. Another possible way, and a couple of other options that you do have as well, is what's called the government's co-contribution scheme. If you're earning less than around $54,000, you make an after-tax contribution into super, the federal government will chip in up to $500 each financial year. You can also put contributions in on behalf of your spouse. And depending on their assessable income, you can also possibly qualify for a tax offset. So more dollars back in your pocket. So as you can see, lots of potential opportunities to boost up your super as you're heading towards that comfortable retirement lifestyle. In order to access your superannuation, you do need to have reached what's referred to as your preservation age, which will be between the ages of 55 to 60 and met a condition of release, which is generally retirement. If you reach this age and you're still working, you can choose to draw on your super under what's called transition to retirement rules. Some rules do apply, and we'll look at these very shortly. There's 4 main reasons why someone would access their super using transition to retirement. It can be an opportunity to boost up your super. This strategy involves increasing those before tax contributions to super and drawing a tax-free income once you've reached the age of 60. So that's basically a way to minimise your tax, your marginal tax. You can work less. A lot of members that we work to have been working in the various industries for a number of years. They're not quite ready to retire. They'd like to reduce their working hours, but they still have financial commitments. So a transition to retirement strategy can allow people to ease into retirement and maintain a certain level of income. It could be an opportunity to pay debt. I spoke to a member just the other week who was 60 years old, wanting to retire at about 65, 66, but they would really want to clear off the mortgage so they could retire debt-free. Transition to retirement could be one opportunity to do this. They could look at maybe drawing some money down to pay the debt and ideally leaving themselves enough time to put contributions back into super so they could stay at a very similar super balance, again, achieve that comfortable retirement lifestyle and also retire debt-free. As we've touched on, estate planning. Using a very similar process to the first one we talked about, this involves drawing a tax-free income on or after 60 and putting that back into your super, which will change your tax components. Now, it's very important. I said at the start, have a plan in place before you do anything, and the earlier the better. Remember, if you're accessing your superannuation before retirement, that could impact on your future retirement lifestyle. So think about what you're wanting to achieve and what sort of lifestyle you're aiming for. So how does transition to retirement work? It simply starts by transferring an amount from your accumulation account into an income stream. If you are in a defined benefit, it can be a little bit more complex, so I'd recommend talk to us one-on-one and we can give you some more general information and some guidance. Because you're still working, your employer continues to put money into your accumulation account. So, and you're also receiving a regular income from the pension or the income stream. Now, many members do choose to set up the transition to retirement once they reach the age of 60. because income from super at 60 years old is tax-free. You're able to do this at your preservation age. If you're under 60, it's a little bit more complex. So again, come and have a chat to us if you'd like to find out more. Under federal government rules, you must withdraw a minimum. The legislated minimum is 4%, but for the current financial year, it has been halved to 2%. From the 30th of June 2023, that will return to 4%. There's also a maximum amount, which is 10% of the balance. Now, you are unable to make lump sum withdrawals from your superannuation while you're still working. So just to recap, so from the 1st of July 2023, that minimum will return to 4% of the balance. You're also unable to make lump sum withdrawals from your income stream until you meet a condition of release. So that's transition to retirement when you're still working. What about when you finish work for good? What are the options that you have? Now, the good news here, that superannuation doesn't necessarily stop once you stop work. You can continue to use your superannuation as an income and investment vehicle even once you've stopped working. Now, for most people that we talk to, super is going to be the second most significant source of income when they come to retire. The goal is to make it last as long as possible when it comes through to retirement. You've got the option. You can transfer some part or all of your super into an income stream. This provides you with a regular source of income, which effectively replaces your pay from work. Many members choose this option as it can be easier to budget or manage your spending. There can also be tax advantages. Again, once you turn 60, any money you're drawing down from the pension or the income stream is tax-free. The investment earnings are also tax-free. Once you've reached that condition of release, you also have the option to make lump sum withdrawals as you need to. Minimum payments do still apply. However, there's no maximum once you've met that condition of release. Under federal government legislation, you can't add to an income stream, but you do have the option, if you wish to, of keeping some money in an accumulation account. And even once you've retired, you can continue to contribute to super if you choose to using the accumulation account. Again, you might receive a lump sum. You want to invest that within superannuation. You might pick up some work here and there. And what about the age pension? I mentioned this earlier on. There have been a few changes over the years, but for many people that we talk to, the age pension will certainly form a very important part of their retirement savings. It's one of the pillars of the retirement income. The age pension was introduced back in 1907, and it's certainly gone through some changes, particularly in recent times. Eligibility for entitlements does require you to have reached your pension age, and this is based on the year at which you were born. For most people these days, pension age is 67. Once you reach pension age, two separate tests will apply. Really important to note that if you're part of a couple, the Department of Human Services will apply these tests to both of you to determine how much, if any, age pension you might receive. The first is the income test. This test is likely to apply if you're still working rather than when you've fully retired. And that's a really important point. A lot of people think that if they or their partner is working, you can't qualify for the age pension. It's also very important to note that any income you're drawing down from your super is counted under the income test. So it might be tax-free, but it can potentially be counted for Department of Human Services purposes. This test is more likely to apply once you've retired. It's referred to as the asset test. One thing to keep in mind, that the home in which you live and up to 2 hectares is exempt from the assets test regardless of the value of the property. Assets can include money in super for you and your partner once you've reached pension age, investment properties, cash in the bank, or a share portfolio. A commonly asked question, what about your household goods? Well, unless you've got a few Picassos on the wall at home or a Ferrari or 2 in the garage, this may impact on your pension. Otherwise, you can consider fire sale costs. When providing this information to the Department of Human Services, you can generally be pretty conservative when it comes to costing those assets. The Department of Human Services will apply both of these tests to your overall situation, and whichever one gives you the least pension is the one that they will use. So, If you do pass both of the tests, how much age pension can you potentially expect to use? Now remember, you can also receive the part pension in conjunction with your superannuation and other investments to allow you to fund that retirement lifestyle. But let's have a look at the full age pension figure. It's fair to say that the full age pension will allow you to maintain a certain level of lifestyle in retirement. And take a moment to look at these numbers. Make a bit of an assumption here, but if you look at these numbers in comparison with the figures that we looked at earlier on as required for determining a comfortable lifestyle, according to ASFA, there's a bit of a gap. So it probably means that if you are relying just on the age pension in retirement, you're probably going to be giving up some parts of your lifestyle when you do come through to retire, which again, why early action is so important. And remember, your lifestyle is specific to you, and that will determine how much you'll need when you come through to retire. Think about what you may spend now and what may change in the future. Once you've established your income needs in retirement, you also need to think about the future. And we've touched on this earlier on. Estate planning is a really important part, particularly as a retirement planning process. You will need to give your superannuation funds instructions as to who your money goes to in the event of your passing. If you've got a will, under legislation, super funds don't automatically follow those instructions. Super funds can generally only pay to a dependent, and this can include a spouse, a child or children of any age, someone who's determined as being a financial dependent, or somebody who's classified as being in an interdependent relationship. And there's a few different options that you have. A preferred beneficiary is a guide as to how you would like your benefit distributed in the event of your death. It's completed online, you can nominate non-dependents, and there's no time period required for renewal. Brighter Super is legally required to identify all of your dependents if you have the preferred nomination and pay your benefit according to the rules set out under legislation and under our trust deed. A binding beneficiary is legally binding on the super fund, and that means that we will pay your death benefit to your nominated beneficiary or beneficiaries. It's a legal document, so it must be completed in writing. Beneficiaries must be a dependent or a legal personal representative. A binding nomination is valid for a maximum of 3 years and will notify you prior to its expiry. You've also got the option of a non-lapsing binding beneficiary, which is the same as the above, however, it has no expiry date. A reversionary nomination is specific to the income stream or pension account. A reversionary beneficiary will allow the income stream to continue to be paid directed to your beneficiary, generally your spouse, in the event of your passing, which means that money stays within super. With those different options available, it's really important to consider your own circumstances and talk to us if you'd like some more information. We have covered a fair bit of information this evening. And the big question is, well, where do we go to from here? Very shortly, we'll be opening up the webinar for questions, but it's really important to know that we are here to help and support you every single step of the way. At the Brighter Super Group, we're here to support you with your general and also personal advice about your super. If this evening's webinar has raised questions, you can give our contact centre a call, and we've got the numbers there on the screen. The staff and the member services team do a fantastic job answering general and factual questions and about your superannuation and also giving you some direction. One of the services that we do provide to our valued members is a super health check, a half an hour complimentary one-on-one with a superannuation expert to have a bit of a run through your super. We regularly travel all over Queensland in the workplace to provide these to our members. You can also book in through the website for a phone or a digital meeting in the comfort of your own home or workplace. Once you've got the information that you need, personal advice can give you that roadmap to get you on track to achieve your comfortable lifestyle. You've got a couple of different personal advice options. You can book in with one of the members of our Scale Advice team, and they focus specifically on what you can do with your superannuation. So it may be reviewing your contributions into super. It could be looking at investment strategies, so taking you through that risk profile, or insurance needs through your super. This is all part of your membership, so it's at no additional cost. Alternatively, you can book in for a meeting with one of our comprehensive advice team for more detailed financial planning advice. Now, they can look at areas outside of superannuation. So it could be looking at how the age pension may factor in to helping you get the income source that's right for you. It might be looking at general retirement planning advice. It could be looking at estate planning needs that you do need, or investment strategies outside of superannuation. You can talk to one of our financial advisors and arrange a no obligation meeting. And during the course of the meeting, they'll talk about some of the strategies that they can put in place for you based on your personal circumstances. And also, I'll explain to you what the costs are involved if you do wish to go ahead and get that personal financial advice. Again, we've covered a fair bit of information, so I'd like to thank you again for the opportunity to talk to you all here this evening. And I do hope that you've got a lot of useful information to putting your own individual plans into place. What I always like to encourage people to do at the end of these types of sessions, think about one step, one thing that you'll do when it comes to achieving your own comfortable. And make sure you do a commitment to yourself to come put that into place and also revisit that in the future as well. And remember, we are here to help you every single step of the way. Now, on that note, I'd like to hand you back to Kate to take us through the question and answer session.
Thanks so much, Dan. We hope that you enjoyed that presentation. So we'd now welcome any of your questions. If you'd like to ask a question, simply click on the blue hand at the top of your screen. So we'll endeavour to get through as many questions as we possibly can, but rest assured that if we don't, we'll call you back with an answer. So I will start off with the first question. It's a great question, actually. It comes from Adam. Hi, can anyone join the Energy Super Fund? For example, my wife who doesn't work in the energy industry. We would love to have your wife, and of course we've been open for a while to anyone outside of even our industries of local government and energy. And so please go to energysuper.com.au and fill in a form or give us a call. Right, next question from Guy. How do we as new members through the Suncorp sale engage with the free advisors? Do they provide general or personal advice? Great question, actually. Thanks for that one. So the free advice is a service that will be commencing in a couple of months. It will be going to the board very shortly. We've been doing the work to set it up. So when it is available to you, we will communicate with all of our Suncorp Super valuable members, and we look forward to being able to include you with some of these additional services that we're able to offer your fund. So I've got a question for you, Dan. This comes from Tracy, and it's around nominations. So the question is, can your nomination be to my estate?
Great question. The answer to that is yes. You can nominate the executor of your estate, and your instructions or will be followed using either the preferred or the binding beneficiary option. Fantastic.
Don't forget that if you want to submit a question, please press the little blue hand at the top of your screen. So another question here, and I think I'll give this one to you. This one comes from Helen. Can I access my super and still work part-time?
Very good question, Helen. The answer is yes, and potentially two options. You could, if you've reached preservation age, you could set up a transition to retirement income stream. If you are reducing your working hours to part-time, the only other way you could access super as a lump sum would be if you had money that was available, what's referred to as unrestricted, non-preserved. And also, if you were working past the age of 65, that's also classified as a condition of release.
Thanks very much. And another follow-up question on this one, actually. This is around the lump sum. So you talked a little bit earlier about how you can put a lump sum into your super. Could you just quickly go over that for us again?
Yeah, certainly. So in relation to the contribution limits, if you're making an after-tax contribution to super, say a lump sum, you can put in up to $110,000 per financial year. You also have the option of triggering a bring forward, which effectively says over a rolling 3-year period, you can put in up to $330,000. And remember, for after-tax contributions to super, you don't have to meet a work test. However, once you reach the age of 75, you can't put contributions into super any longer.
Great. A question from Sharon. How do you find out the preservation age? Very good question. That's confusing.
That's a great question. Thanks, Sharon. Preservation age is based on your date of birth. So for anyone born before the 1st of July 1960, your preservation age is 55, and it gradually increases. So it goes up to someone born on or after the 1st of July 1964, your preservation age is 60.
So a question here from Paul. So are there any more mergers and acquisitions planned? At present, we are working very vigorously. I hope you can see this to ensure that the work that we're doing with Energy Super and Suncorp Super integrations are proceeding as quickly as possible so that we can deliver as many benefits as possible to you, our members. APRA, the Australian Prudential Regulation Authority, who is our regulator, has said that the minimum level of funds for viability is 30 billion. We're only just at that level once we have completed the integration between Energy Super, LGR Super and Suncorp Super. So it is likely that into the future we will need to do one more merger. But our board is incredibly committed to ensuring that we maintain our personal service, that we continue to deliver efficiently for you, and that we don't get too big, because we like the agility that we can deliver to you at our current size. Another question here from Jane. With the downsizing of property and you meet the criteria, do you pay tax at a marginal rate given it's going into super?
Answer to the question is no. Under the downsizing rule, the contribution will be going in as an after-tax contribution, so there's no tax deducted when it enters the super fund. Thank you, Jane.
Great. Another question here from Leah. If you don't have dependents, can you still nominate a beneficiary who's not related?
Great question, Leah. The answer is yes, you can. You can use the preferred beneficiary option, which you can nominate a non-dependent. The other alternative would be, if you have a will, you could nominate the executor of your estate, and then you have the option of also the binding and the binding non-lapsing beneficiaries to choose from. Thank you, Leah.
Thanks for that. I'm conscious of the fact that we haven't spent much time talking about investments tonight, and I know that that is one of the most interesting things to us, particularly at the moment with the level of volatility and media attention that superannuation and investment funds are getting. We don't have our Chief Investment Officer here with us tonight, but if you are interested in hearing what he's got to say about performance over the last year, markets over the last year, and what he expects for the next period or so, including, I have to say, quite a grilling question and answer session, then please just head to our website where you will find our last webinar, which was a fund and investment update. So before concluding, I wanted to remind you that our fund is not just for those who are in local government, the energy industry or Suncorp employees, but is open to everyone. So to learn how your spouse, friends or broader family can join, go to brightersuper.com.au or energysuper.com.au. So thank you all. That draws to a close our webinar for this evening. I do hope this presentation was beneficial for you and that you can see that we'll continue to work hard for your best interests. Thanks again for attending and have a fantastic rest of the evening. Good night.